Been getting a lot of questions about SVB, Silicon Valley Bank, what that means for the mortgage world from clients and from realtors. So just wanted to make a really quick video, really oversimplified explanation of what happened, why it happened, and what that means for both the market, real estate, in the next coming months. So first things first. So when you make a deposit for any bank, let's say you deposit $100,000 into your local bank. Biggest misconception is that money is just sitting there, right? So when you make that deposit, the bank agrees to pay you interest on your deposit, right? And so what they then do with your money is it doesn't just stay there. They take that money and they go try to make money on your money, right? And so they know that, let's say they guarantee you a 0.5% rate for keeping your money there. They know that they then have to put your money somewhere where it will make over that. And the delta between the 0.5% and what they make on your money is how a bank is profitable. So where SVB got into trouble is, so historically banks would accomplish this by purchasing secured loans, things like auto loans, small business loans, things like that. However, with the pandemic, we saw the demand for those kind of loans come down, right? And so what SVB did and what some other banks did that are struggling right now is they purchased assets, right? And one of the more common assets that they purchased was a what's called treasury bonds. So specifically SVB, in the past few years, they purchased about $80 billion of treasury bonds using their clients' deposits. And so what happened, and we've talked a lot about this, but the Fed, when they aggressively have been increasing interest rates to fight off inflation, one of the unintended consequences of this aggressive of a increased interest rate is it essentially caused something that is called an inverted yield. And so historically on treasury bonds, the longer the term, the better return that you get from them, right? So it's safer. The longer, if you do a 30-year treasury bond, that is a safer bet for the government than if you do a 6-month treasury bond, right? So they're going to reflect that by paying you more for the longer term than they would for the shorter term. When you see interest rates hike as quickly as they did and the inverted yield there, what that means is you're actually getting more money for a short-term bond than you would for a long-term bond. So SVB looked up in this market and they realized that they had a whole lot of treasury bonds that weren't worth what they bought, which in theory isn't a problem. It's only a problem if your clients and the people that have your money in your bank want their money back, right? And so where the problem lied is people started to kind of research into their balance sheet and they realized, hey, wait a second, we don't have, SVB doesn't have enough money in profit to cover the loss that they would have with these treasury bonds. So word got out. There was then a run on the bank where everyone tried to pull their money out, and exactly what they hoped wouldn't happen happened. Right? They did not have enough money because those bonds that they had purchased they weren't able to sell for what they had purchased them for. So the Fed had to step in. The Fed is now buying those treasury bonds for what they paid them for. So they're making them whole. They're holding on to those, and they are going to let those mature, most likely not lose as much money on them. So that's kind of SVB in a really condensed nutshell, right? What does that mean for you as a buyer or just someone in the real estate market? There's definitely a silver lining here because over the next few months there is going to be a whole lot of uncertainty in really the market and in the financial world. And if you're prepared and you're in a position to capitalize on that uncertainty, that's really going to be a very profitable position to be in, right? So if you're able to secure a home here in the next few months when uncertainty is high, you're most likely going to get more value for that home than whenever everything's been figured out, the market's turning in the right direction, rates have lowered, everything like that. So not only is it going to make sense from just a value perspective, right? Buying low and selling high, but it's also going to make sense. Real estate historically is a very safe place to put your money. It's going to appreciate, consistently over time, whereas more shorter term things like stock market, things like that, it's always going to be more volatile depending on the time. So Long story short, this has created a good opportunity to purchase real estate. And if you do have any questions on that, I would love to help.